You believe you are an investor. You put money into the market, you watch it move, you hope it grows, and you tell yourself that you are being responsible with your future. But Benjamin Graham, the man who personally taught the greatest investors of the last century, would look at what most people actually do with their money and call it by a very different name. He would call it gambling. And here is the uncomfortable part. The overwhelming majority of people who are absolutely certain they're investing are, by Graham's precise definition, speculating, and they have no idea. By the end of this video, you are going to know with complete certainty which one you truly are. Because Graham gave us an exact test, 3 specific questions that draw a hard line between the investor who builds lasting wealth and the gambler who eventually loses everything. And the difference between the two is not how much money you have, how clever you are, or even what you buy. It is something far more subtle and far more dangerous, because you cannot fix a problem you cannot see. So I want you to do something as you watch this. I want you to put yourself on trial. Take the way you handle your own money, the decisions you have made, the things you own right now, and hold them up against Graham's 3 tests one by one. Be honest with yourself, because nobody else is watching, and the only person who pays the price for a comfortable lie here is you. By the time we reach the end, the verdict will be clear, and you will never look at your own financial decisions the same way again. And I should warn you now, the verdict surprises almost everyone, because the people most confident that they are investors are very often the ones standing deepest inside the casino without realizing the door ever closed behind them. Let us begin with the definition itself, because Graham was a precise man, and he refused to let people hide behind vague words. He wrote that an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. And then he added the part that most people skip over. Operations not meeting these requirements, he said, are speculative. Read that carefully, because it is the entire foundation of everything that follows. Graham did not say investing is when you buy stocks and speculating is when you buy lottery tickets. He did not divide the world by what you buy. He divided it by how you buy and why. You can buy the exact same share of the exact same company on the exact same day as another person, and one of you is investing while the other is speculating. The asset is identical, the behavior is not. And it is the behavior, not the asset, that determines which side of the line you stand on. This is the single most important idea in the entire chapter, so let me make it concrete. Imagine 2 people both buy shares in the same large, well-known company this morning. The first person has studied the business carefully. They understand how it makes money. They have looked at what it owns and what it owes. They have a reasonable sense of what it is genuinely worth, and they bought it because the price was sensible relative to that value. The second person bought the very same shares because a video told them it was about to explode, because a friend swore it would double, because the price had been climbing and they were afraid of missing out. Same stock, same price, same moment. One of them invested, the other gambled, and when the market turns, as it always eventually does, you will instantly see which was which, because one of them knows what they own and why, and the other only knows that the number is supposed to go up. Now let us put you on trial. Here is Graham's first test, and it is the one most people fail without ever realizing it. Thorough analysis. Before you put your money into anything, did you actually understand what you were buying? Not the ticker symbol, not the story, not the hype, the thing itself. If you own a piece of a business, can you explain how that business actually earns its money, roughly what it is worth, and why the price you paid made sense? Or did you buy it because someone you trusted said it was a good idea, because the headline was exciting, because everyone around you seemed to be buying and you did not want to be the only one left out? Be honest. Most people, if they are truly honest, have almost no idea what they actually own. They own a name and a hope. And Graham would tell you bluntly that a name and a hope is not analysis. It is the absence of analysis dressed up as confidence. If you cannot explain in plain language why what you own is worth what you paid for it, you have already failed the first test, and you are closer to the gambler than the investor, no matter how respectable your brokerage account looks. And do not comfort yourself by pointing to the experts you are trusting, because trusting an expert you cannot question is not analysis either. It is simply borrowing someone else's confidence and calling it your own. Here is the second test, safety of principle. This is the one that separates the people who survive from the people who get wiped out. Graham believed that the first and most important question is never how much can I make, it is how much can I lose and can I survive it. The investor structures their decisions so that even if they are wrong, even if things go badly, their core capital is protected and they live to invest another day. The speculator does the opposite. The speculator focuses entirely on the upside, on the dream of the gain, and gives almost no serious thought to what happens if the dream does not arrive. So apply this to yourself. When you bought what you own, did you genuinely think about what would happen if you were wrong? Did you ask how far this could fall and whether you could withstand it? Or were you so focused on how much you might make that the possibility of real loss never seriously entered your mind? Because here is the truth Graham understood in his bones. Hoping a price goes up is not the same as protecting yourself if it goes down. Hope is not a safety mechanism. Hope is the gambler's only tool. And if the entire foundation of your position is the hope that the price climbs with no real protection underneath you, if it does not, then you have failed the second test and you are speculating, whether you call it that or not. And now the third test, the one that is the most surprising, because it sounds backward until you understand it. Adequate return. Notice the word Graham chose, not maximum return, not extraordinary return, not the highest possible return, adequate. Graham believed that the investor seeks a reasonable, sensible return, the kind that compounds steadily over decades into real wealth. The speculator, by contrast, is reaching for something extraordinary, the quick double, the 10 times gain, the life-changing windfall that arrives in months instead of years. And here is the trap that catches almost everyone. The very desire to get rich quickly is itself one of the clearest signatures of speculation. The moment your goal shifts from building wealth steadily to striking it rich suddenly, you have crossed the line, even if you are still buying the same respectable assets. So ask yourself honestly, when you put your money in, what were you really hoping for? A sensible return that grows patiently over many years, or a fast, dramatic gain that would change your life by next spring? Because if it was the second one, if you were reaching for the jackpot, then no matter how sophisticated your strategy sounded, you were sitting at the gambling table and you simply did not recognize the felt under your hands. Now, you may be feeling uncomfortable right now because if you applied those three tests honestly, you may have just discovered that you have been speculating while believing you were investing. And I want you to sit with that discomfort for a moment, because that exact discovery is the most valuable thing this video can give you. Graham believed that the single most dangerous person in all of finance is not the reckless gambler who knows he is gambling. That person at least understands the game he is playing. The most dangerous person is the one who speculates while sincerely believing he is investing, because he takes enormous risks while feeling completely safe. He bets the future on hope while telling himself he is being responsible. He has no defenses because in his own mind he sees no danger. And when the reckoning comes, and it always comes, he is the one who is most completely destroyed because he never saw it arriving. The reckless gambler keeps a little money back because somewhere inside he knows the table can turn. The man who believes he is investing keeps nothing back because in his mind there is no table at all, only a sure and rising path to wealth. He is the one who borrows against his house to buy more. He is the one who puts his retirement, his children's future, his entire margin of safety into a single rising bet because he has convinced himself it is not a bet at all. This is why Graham reserved his sharpest warnings not for the obvious gambler, but for the sincere and confident man who had simply never learned the difference between the two words. That man does not lose a little, he loses everything. And he loses it precisely because he felt so safe. But here is where Graham becomes genuinely fair and where this stops being an attack and becomes something useful. Graham did not believe that speculation is evil. He did not tell people they could never speculate. That would be like telling people they can never gamble, when the truth is that some people will gamble no matter what anyone says. What Graham insisted on was something far wiser. If you are going to speculate, do it knowingly. Do it with your eyes open. Never, ever confuse it with investing, and never let it touch the money you cannot afford to lose. He suggested that if the urge to speculate becomes irresistible, you should wall it off completely. Set aside a small, strictly limited amount of money, an amount you could lose entirely without it changing your life, and keep it in a separate account, mentally and literally, apart from your real investments. Speculate with that, and only that. The fatal error is never speculation itself. The fatal error is letting speculation creep into the part of your life that is supposed to be safe and bringing the gambler's mindset to money that was meant to protect your future. Let me show you how this plays out in the real world, because the patterns repeat in every generation with a different costume. Think of the people who pour their savings into whatever asset is exploding in the headlines, convinced that this time is different and the price will only keep climbing. Think of the person who buys a stock purely because a confident voice online promised it would multiply 10 times, having never once looked at what the underlying business actually does. Think of the person who jumps in and out of the market every few days, chasing momentum, certain they can feel where the price is going next. Think of the person who hears a hot tip at a dinner party and moves a meaningful chunk of their savings the very next morning. Every one of these people would describe themselves as an investor. Every single one of them, by Graham's precise definition, is speculating. They have done no real analysis, they have no protection of their principal, and they are reaching not for an adequate return, but for an extraordinary one. 3 tests, 3 failures, and they do not even know they are taking the exam. Graham did not learn these distinctions from a textbook. He learned them in the most expensive classroom that has ever existed, which is the experience of being destroyed by his own mistakes. In the years leading up to the crash of 1929, the entire country had blurred the line between investing and speculating into nothing. Ordinary people were borrowing heavily to buy stocks, convinced that prices could only rise, certain that they were building their futures. They called themselves investors. They were, almost to a person, speculators who had forgotten the word even existed. And when the crash came, it did not merely take their gains, it took everything, because they had no safety of principle, no margin underneath them, nothing but hope and borrowed money. Graham himself was caught in it. He suffered enormous losses, and he spent the years that followed thinking with brutal honesty about exactly what had gone wrong. What he concluded was that the catastrophe had not been caused by bad luck or by a cruel market. It had been caused by millions of people speculating while believing they were investing, taking on ruinous risk while feeling perfectly secure. The line between the two words was not academic to Graham. It was the line between the people who survived and the people who were wiped out. And he had watched it claim almost everyone around him. That is why he wrote with such force about this distinction and why he placed it at the very beginning of everything he taught. He understood that you cannot build a sound financial life on a foundation you have misunderstood. If you think you are investing when you are actually speculating, then every other good decision you try to make is built on sand, because the ground beneath you is not what you believe it to be. The first and most essential act of intelligent investing, before you ever choose a single asset, is to know honestly which game you are actually playing, because only then can you play it deliberately with the right rules, the right expectations, and the right defenses. So let me give you what to actually do with this now that you have put yourself on trial. The first step is simply to be honest about your verdict. Look at what you own right now and run each position through the 3 tests. Did you analyze it, or did you trust a story? Is your principal protected if you are wrong, or are you running on hope? Are you seeking an adequate return or chasing a jackpot? Wherever you find a position that fails all 3, you have not found an investment. You have found a bet, and you should at the very least know it is a bet so that you can size it accordingly and never mistake it for the safe part of your financial life. The second step is to draw Graham's wall deliberately. Decide consciously which part of your money is for investing, governed by analysis, protected against loss, and aimed at sensible long-term returns, and which part, if any, is for speculation, kept small, kept separate, and never allowed to grow into a threat to your real future. Most people never draw this line at all, which is precisely why their speculation quietly contaminates their entire financial life. The act of drawing it, of saying this money is serious and protected, and this small amount over here is where I allow myself to gamble, is itself one of the most mature financial decisions you will ever make. And the third step is to change what you are actually reaching for. So much of the difference between the investor and the speculator lives in that one word, adequate. The speculator is always straining for more, faster, bigger, and that straining is exactly what leads them to abandon analysis, ignore safety, and chase the extraordinary right off the edge of a cliff. The investor makes a kind of peace with patience. They accept that real wealth is built slowly, that an adequate return compounded over decades becomes an extraordinary one, and that the desire to skip the years and seize the fortune immediately is not ambition. It is the gambler's impatience wearing the mask of ambition. When you stop reaching for the jackpot and start respecting the slow, certain power of adequate returns compounding over time, you have not lowered your ambition. You have finally pointed it at something that actually works. Let me put real numbers to this, because Graham believed that a principle without arithmetic is just a feeling. Imagine an adequate return of around 10% a year, the kind the broad market has produced over the last century. It sounds almost boring. It is not the number that excites anyone at a dinner party. But invest a steady amount at that adequate return for 30 years, and the arithmetic becomes something the speculator can only dream about. The patient investor, reaching only for adequate, ends up with a fortune. Meanwhile, the speculator, who spent those same 30 years chasing the spectacular, jumping from one extraordinary opportunity to the next, almost always ends up with less, often far less, because the occasional big win is wiped out by the inevitable big losses, and the constant activity bleeds them dry. This is the cruel joke at the heart of speculation. In reaching desperately for the extraordinary, the speculator usually ends up with far less than the investor who calmly accepted the adequate. The tortoise does not just win the race, the tortoise wins it by a margin that would astonish the hare. So now we arrive at the question I promised you at the beginning, the one you can finally answer for yourself. Are you investing, or are you just gambling? You now have the exact test Graham used to draw the line. Thorough analysis, safety of principle, an adequate rather than an extraordinary return. Hold your own decisions up against those three, honestly, with no audience and no need to impress anyone, and the truth will be undeniable. And if the verdict is uncomfortable, if you have realized that you have been speculating while calling it investing, then understand that you have just received the most valuable lesson Graham ever taught, because the gambler who finally sees the table for what it is has already taken the first real step toward becoming an investor. The ones who never escape are the ones who never even knew they were playing. Graham spent his entire life trying to move people across that line, from the hope of the speculator to the discipline of the investor, because he had seen with his own eyes what happens to those who never make the crossing. He watched a generation destroy itself by confusing the two words, and he dedicated everything that followed to making sure his students would never make the same mistake. You have now been handed the same understanding that protected the greatest investors of the last 100 years. The only question that remains is the one that has always mattered. Now that you can finally see the line, which side of it are you going to choose to stand on? Because from this moment forward, you no longer have the excuse of not knowing it was there.